Hi, and welcome back. You'll find these learning objectives in your chapter checklist. Please review them as you work your way through the chapter. We are continuing our journey down the balance sheet to the last section before equity. That's long-term liabilities. Remember that liabilities carry a normal credit balance and increase with credits. You remember that short-term liabilities are expected to be paid within 12 months, right? While long-term liabilities are expected to be paid after 12 months and to be on the books for longer than 12 months. Sometimes for several years, as is often the case with mortgage notes payable and bonds payable. Why would we want to incur long-term debt, you might ask? Typically, it's because we need some cash to maintain our operations or expand our business. We can choose to issue debt in the forms of notes payable or bonds payable to purchase a new building or open locations in different parts of the country. We'll start the chapter by revisiting notes payable, and then we will discuss bonds payable at some length. As you'll see is true with bonds payable, companies issue notes payable to obtain assets and cash. But unlike bonds, notes are typically made with a single lender, such as a bank. We discussed short-term notes payable in a previous chapter. Long-term notes payable are simply notes that are not paid back within 12 months. As you remember, when the note payable is issued, the lender provides the cash to the company, and the company signs a note payable contract agreeing to repay the principal plus interest. When the note is first signed, the company debits cash or another asset and credits note payable. Until the time that the company fully repays the note principal, it must record the cost of borrowing the money, the interest expense, each and every period. Let's look at two common ways to structure the repayment of principal and interest. For some notes, the principal and interest are paid in a single payment at the end of a note term. This is the type of note we looked at in the previous chapter, so you may want to look back at your notes if you need to review these concepts. Other notes require regular payments during the note term. We call these notes installment notes because our payments are made in regular installments. In some cases, the regular payments consist of equal payments that include both principal and interest payments. Most car loans and mortgage loans are like this. The payment is the same every month and consists of interest and some principal payment. And in other cases, the regular payments consist of equal principal plus interest. When each of an installment note's payments are equal, the amount of the principal payment increases each year as the interest expense payment decreases. Most consumer notes to purchase items such as cars and refrigerators are installment notes that require equal total payments. In cases where payments include equal principal payments, the amount of cash paid each period decreases as interest expense also decreases. And finally, a mortgage is a legal agreement that helps protect a lender if a borrower fails to make required payments. A mortgage gives the lender a right to be paid from the cash proceeds of the sale of a borrower's assets identified in the mortgage. Mortgage notes are especially popular in the purchase of homes and the acquisition of plant assets. A legal document called a mortgage contract describes the mortgage terms and gives the lender the right to sell the house or the other asset and to be paid out of the cash proceeds from the sale if the borrower defaults on the loan payment. See you in the next video lecture where we will discuss another type of liability, bonds payable.